Hey, it's January 15th, Friday. What's coming next week is an inauguration. There's a lot of news, a lot of financial news. We're going to talk about that a little bit. But one of the things that I promised that we would do for the podcast is answer questions from people who are watching. We're forwarding it to other people, and they have a financial question. What we see a lot is that you could talk about these very broad concepts, and that's good because we need to know the concepts. We need to understand what's going on. But then it really kind of gets a little bit more granular and about your situation. And so we're never going to use your name unless you tell us to, but otherwise we just answer the question. And it doesn't matter who it's from, but these are coming in from via email. And you can email your questions, and it's going to be right here somewhere. It's joshua@epsf.com. And if you email a question to that email address, that's the producer, Josh. Josh will give me those questions, and we'll pick through them, and every once in a while we'll answer a few questions from people who are watching. A little bit of an embarrassment today. I had two questions to answer, and I just lost one of them in my email someplace, and I cannot find it. And it should be easier, but it's not. So we're going to start with the first question from somebody who's been watching, and then we're going to talk a little bit about the stimulus plan that got announced last night and what I think is going to happen with it and what 2021 is going to look like because of it. So the first question that we're going to answer is those of us who listen to different talk radio programs hear two commercials pop up frequently with an air of urgency. The first one is buy gold. And I see these all the time, and I want you to think of something. Whether it's gold or silver or stocks or bonds or cars, property, real estate someplace, whenever those people are sending a newsletter to you or doing a commercial or having an infomercial, their main goal is not to give you information. Their main goal is to have you buy whatever they're selling. And gold is no different. Gold has been one of these things that when I first started in my career in 1992, gold was at about $300 an ounce, and it was falling at the time. Hadn't made money in a long time. And then after 2008, when we started pumping money into the economy at a breakneck pace, gold started to rise in value. It's mainly a hedge against inflation. It's not something that I would ever generally buy because I think it's just a great investment. It's simply a hedge against inflation. Now, think about what's happened with inflation in the last few years. Absolutely nothing. That's what's happened with inflation. We have put so much money to work in the economy via stimulus plans, all starting in about 2009. They did about $800 billion in 2009. Nothing has changed. We've cut taxes, putting more money into the economy. And at its simplest form, inflation is simply too much money chasing too few goods. So think of it this way. There's one car for sale. That's it. There's one car for sale. And there's 10 people who want to buy it. The price is going to ratchet up because now there's scarcity. If there's too much money chasing too few goods, there's going to be inflation. We have been trying to create inflation since 2008 and haven't been able to do it. We might get it right this time. There might be inflation. It surprises me that there hasn't been inflation. So the people who have bought gold would be rewarded for that. Now, in general, when I tell people to buy gold or I recommend it, it's usually about 5 or 6 or 7% of a portfolio because traditionally it hasn't performed very well. The stocks have way outperformed gold, even though gold has performed. So if you were going to do 5, 6, 7% of your portfolio in precious metals, I would have gold be part of it, but that's about the limit to it. So when people tell you, well, I have gold in case the economy collapses, oftentimes I'll ask them, what are you going to do with the gold when the economy collapses? Well, I'm going to buy groceries. Okay, tell me how that works. Are you going to shave off a piece of your coin or your gold bullion? To me, in times of extreme distress, the most precious metal is brass. Why is it brass? Because it fits into a 9mm really easy. And that's going to be the most precious of metals. If we ever got to the point where you needed to shave off pieces of gold to buy groceries, groceries will be the least of your worries in that scenario. So I like gold. I don't like it nearly as much as the infomercials do. I like precious metals more. I like to quantify it in that sense of greater than just gold. You're looking at platinum, palladium, silver. Platinum is really a nice precious metal because as the economy improves, it gets better. It's used in catalytic converters. It's used in a lot of construction. It's used in microprocessors. So I like that because as the economy expands, that metal is going to get used more. But I would get a basket of precious metals. You could do it in an ETF. You could own the metals themselves. There's carrying costs. You know, if you actually buy the precious metal, you got to put it someplace now. You got to have a safe or you got to store it someplace. Those things cost money. So that's my spiel on precious metals. No more than 10% of your portfolio. And I think you will be rewarded long term for having limited your exposure to them because traditionally they just don't perform like equities do. The next question is about annuities. The same person said they see another commercial when they're or listen to talk radio, they'll hear this. Invest in annuities to guarantee your investment. If the market goes down, you don't lose any money. In the past, pre-2008, actually pre-2000, in the market was very popular, these things called index annuities. And what they do is you put in your money and you invest in an index. And if that index goes up over time, you get a piece of that. When interest rates were much higher, you got a much bigger piece of that index as it went up. As interest rates started to fall in the early 2000s, those participation rates sank to, I mean, they're de minimis. So if you have an S&P 500 index that you're investing in, you might get a very tiny fraction of that S&P 500 index as it goes up. For instance, in 2020, the S&P 500 did very well. You might have only made 5-6% in your annuity. Plus, you were going to back out charges. So index annuities, which is what this question is really about, it's a compelling argument. If the market goes down 50%, you don't lose any money. When the market went down in 2008 and people did lose 50%, not only did they recover in a relatively short period of time, about 8-9 months, you were back to level. It's taken off so much since then that the way that I would look at an index annuity now is if you wanted to guarantee a small portion of your portfolio. You said, look, if we get to the scenario where the market is falling and just won't recover, Japan had this for a long time. Now remember, their market is very different than ours. Our market is way more complex. Even though they have a very first world economy and a lot of the things that we have, they have, but we just have it on a much grander scale. So our economy has been able to recover from the shocks of 2000, 9/11, 2008, the pandemic. It's been able to recover much faster because it's so complex and diverse. But you made your money back quickly, really quickly. And so I'm not worried about the market going down and staying down right now. What I'm worried about is when the market goes down, people call me and want their money back. That's what I worry about. So if I can convince you when the market goes down to not run away, but instead buy something, you're going to recover very quickly. And that's the way that I look at the market. So I have used index annuities very, very sparingly, mainly because they never deliver what they promise on the upside, very rarely. And the costs are relatively high. And so that the price of safety is really virtually no rate of return. And for me, being in the market for as long as I have been, being in the business for as long as I have been, what I see is that adding risk to your portfolio, even if it's just a little bit, adding some risk to your portfolio rewards you dramatically over time. Now, of course, I cannot predict the future. I don't know what's going to happen with certainty this year. But this is what we do. We have been doing this since 1992. We've gotten pretty good at it. And so I feel confident in saying that no matter what happens this year, in 10 years, we're going to be higher than this. In 5 years, we'll probably be higher than this. And in that time frame, in that space of time of 5 or 10 years, there's going to be some extreme opportunities to buy. February, March of last year, of 2020, was an extreme opportunity to be able to buy into a market that was down. And if you were able to do that, you benefited dramatically from it. And that's what we're looking for. We're not looking to eliminate risk. We're looking to take advantage of it. We're looking to take advantage of when the market falls and people are screaming for the exits, we're buying. And if you can do that, you're gonna be great. Your accounts are gonna go up and everything's gonna be fine. So I would steer people away from index annuities in general, unless they told me, if you lose a dime of my money, I'm gonna find out where you live and I'm gonna kick your dog. If that happened, index annuity, because my wife loves those dogs. And she would rather throw me out in the driveway to be kicked first, I believe. But she does love me. So index annuities probably stay away from. Whenever there's a sensational commercial online or on the radio or on TV, the best thing to do is change the channel. Just watch QVC for a couple of minutes. It's better TV than those commercials. Now the stimulus plan that got proposed last night by the incoming administration, $1.9 billion, probably not going to happen that way. Probably going to be closer to 1.1 billion or 1.2 billion on top of the 800 or 900 billion that we did at the end of the year last year in 2020. So there's a lot of stimulus hitting the market. What's going to happen is when this money gets in there, we do some infrastructure projects and we're mailing out checks to people for another $1,400. It is very stimulative to the economy. It's going to help the market. It's going to drive stocks forward. People are going to be putting money in the bank, taking loans out. I'm not saying it's a bad idea. I don't think it's a bad idea. I think the best idea would be a little bit more nuanced, and I have said this across the board, that it would be better for us and better for the economy if people who had consistently worked were kind of targeted away from, and we could target the people who have been out of work. If we could target people who were consistently out of work or marginally employed over the last 8-9 months, that would be more stimulative because they need the money more. And so somebody who hasn't had their income impacted over the past 9 months, this is just a bonus to them. What we need to do is really get nuanced, get a little bit more granular in this, and target the people who have been most negatively affected. Now, one thing the government isn't really good at, doesn't matter who's in charge, is nuance. And that's going to take some nuance. So they could easily send a check to everybody, but it's very difficult for them to send a check to every third person. So I don't think that's going to happen, but it'd be way better if we could do that. Maybe we will, I don't know, but it's going to be about 1.1 million when it's signed. It is going to get signed, it is going to happen, and that's why I think the market's going to be pretty positive this year. And I don't think that they're going to be able to raise taxes this year because it's very difficult to give people $1,400 in one hand and be taking it away with the other and expect good things to happen in the economy. So tax increases drag money out of the economy. It puts it in the hands of government. They're much less efficient. One of the things that the Trump tax cuts did is it lowered taxes on corporations, which created a lot more investment in the market, and it brought a lot of money back from overseas. So the tax cuts that the Trump administration did were very effective, and they did drive the economy forward. I think the Biden stimulus plan, in a lot of the same way, is going to do the exact same thing. So I'm very positive on the market this year. And then 2022, believe it or not, midterm elections coming. So it's going to be kind of tough to raise taxes into a midterm. They might try it. We'll see. But it's for a lot of people, it's for a lot of politicians, raising taxes into an election, not the best idea. So we'll see what happens. I think we have 18 months of really good economy coming. I think we have a good stock market coming. There's going to be some things that benefit a little bit more than others. I think the banks are going to benefit dramatically because there's going to be a lot more money floating around that they're going to capture. I think the businesses that aggregate people, so in the pandemic, anybody where there was a lot of people, no good. After the vaccine, restaurants, big chains, hotels, cruise ships, believe it or not, airlines, theme parks. And they're going to do well in this because people are going to want to get back outside. So I'm looking at those things. Also with the new administration, that's a little bit more open to alternative energy and green things. We are looking at a lot of different green investments, and we're going to focus a little bit more time and energy and resources to those. And I think those are going to do well. So whether it's EVs or solar panels, wind turbines, things like that, probably going to be a slight curtailing of drilling in public lands. That's going to drive oil prices up a little bit, but that's not a killer because we are an oil-based economy. We are the #1 producer of oil and natural gas. So we have to strike a balance now with natural resources where if the price gets too low, those people are out of work. If the price gets too high, other people are out of work. So there's this equilibrium that we want to find. Haven't done it yet, but I think it's somewhere around $2.50 a gallon of gas. $4 a gallon, people start to change behavior. $1.50 and oil and gas people are out of work. So we want to be in the mix someplace. We're probably going to be paying slightly higher prices at the pump, but it won't be a death nail to the economy. So I want you to like us, subscribe to us. You can find us on a lot of different resources. YouTube is the easiest for people, but Lisbon is another one. Spotify is another one. There's a lot of places where you can find us. Send it out to people. And don't forget, email your questions to Joshua@EPSF. It's probably right across my forehead right now is email address, I'm thinking, because there's a lot of space there to write. So it's a good place for him to put it. Covers up. I have been told, I don't believe this, but I have been told I'm starting to lose my hair. And so I don't know, maybe you have a comment about that or not, but questions, I want to answer questions. And we're going to do this every week. So I want you guys to be subscribing, listening, watching, forwarding. And I look forward to talking to you guys next week. Have a great day.